You made a really bad call on this election. Harris landslide. What went wrong?
Well, thank you, John. I appreciate that. It's a nice way to start the conversation. Always love that.
No elephants in the room here.
Well, look, right. I mean, my thought is it's a good thing we're not paid to be political prognosticators, because we were of the view that the Democrats would win. Women vote, abortion, youth vote, etc. None of that really materialized. And what's really interesting after a few hours of sleep is the idea of good economics has turned into bad politics for the Democrats, right? The Biden-Harris administration, best economic outcome in generations. The U.S. is the envy of the world, best growth, lowest inflation. And the Trump policy mix, which I think economically speaking is going to prove to be not very good, but was clearly good politics. And so as an investor, here we are sitting. We need to think about exactly what we just discussed. You know, is it going to be a sweep? Because that means the policy mix, more of it is likely to materialize. If it's not a sweep, then we'll see how it all plays out. But I think for us at TPW, we're focused on a long cycle opportunity, good global growth, good risk asset opportunity, and a lot of that depends on policy continuity. And I think what we're going to have in the U.S. is clearly policy discontinuity, and the question is going to be, how does that play out? And the setup I'm thinking about, like right now, this morning on the way in here, was you have the U.S., which is an over-owned, expensive asset. Foreigners have never owned more of U.S. financial assets at a time when the policy mix is deteriorating, versus, for example, China, which is a cheap asset, under-owned, just to finish, cheap, under-owned, and arguably the policy mix is improving. City Economic Surprise Index turning up, PMIs above 50. And I think we're going to see, at the end of this week, a further policy response by China, because they understand that their growth right now is export driven, and with tariffs, that could be a big problem.
I wasn't trying to interrupt you, but before we get to
I
China,
don't like that.
Don't interrupt you.
John can criticize me, but no interruptions.
He hasn't slept. I've wound him up. So ready to go.
It's okay.
All right, it's a third down and fourth down. How much do we need to get?
There's a question.
Give me the ball.
There's a question here about whether you then fade this move. If you believe that actually this is not the right policy, do you put your money where your mouth is?
Well, that's a great question. And I thought about that. And tactically, I think you have to enjoy the bounce, right? And the reasons are multifold. First, seasonality. This is the best 3 months of the year for stocks. Positioning is pretty light, right? You're seeing that play out. Right? You don't have 5% moves, 2% moves in the S&P if everybody's already long. So people de-risked. Now they have to re-risk. Technicals are supportive. And importantly, most importantly, fundamentals are supportive, right? We're just coming out of Q3 earnings. They were double what the expectation was going into the earnings season. The projection was 4%, ended up being around 9%. And most importantly, I think we've seen a complete collapse in the VIX. That's what needs to be up on these charts here for Bloomberg, right? The VIX has gone from 25 to 15 in a matter of hours. And
2 hours on TV last night. He's producing now.
I need a new job, John.
I want that up on the screen. Let's go.
I need a new job.
Is that political forecasting he's producing?
Yes, exactly.
You got some sleep.
Something's got to work.
Now you think you could just take over. So your tripolar world, even though your political conviction was wrong, your market conviction, in a sense, was accurate.
Yep, exactly. It goes back to what I said last night. Remember my mea culpa? I think it was 12:50 last night. Was look, do you want to be the old market saying? Do you want to be right or do you want to make money? Right? And I struggled with that for years because my background is a sell side strategist, and so you want to be right. Really important as a sell side strategist. As an investor and an advisor, we want to make money, and so we're fully invested. We're long equities. We are completely out of treasuries, so this treasury move is not affecting us in any way, shape, or form other than helping us beat our benchmark.
What would it take to get back in?
Yeah, that's good. That's, again, the question to be asked, I think. And, it's a little tempting tactically, again, because as I said last night, going into this week, the long end of the treasury market, as represented by ETFs, was massively oversold, right? The RSI, Relative Strength Index for the 7 to 10 year ETF, IEF, was 15. They don't really get down around 15 very often. So tactically, I think you're probably, I wouldn't be a seller if I were as an owner of treasuries right here, the long end. But I think the bigger question is the deficit. And clearly, again, the Trump policy mix, it's not just my point of view, pretty much every independent person who looked at it, or group, Moody's, Goldman, Peterson, et cetera, it's bad for inflation, it's bad for the deficits, bad for rates, and theoretically should be bad for growth. But I think there's an idea that this is going to be a hothouse effect, which is what you guys have been talking about.
So what are you looking for to decide whether or not to bite the bullet, sell stocks, buy bonds?
Yeah, part of it is to see the makeup of the house. Is it a trifecta? Part of it is to kind of like see what China does, right? Because there's going to be a response. You know, we're global, we're multi-asset. So we have the whole world as our oyster, and there are going to be opportunities to play. I think for now, as I said, we enjoy the bounce, we enjoy the ride, and we think about, you know, at some point maybe lightening up. I think for the U.S., I mean, I think the call for us is going to be, if we really do believe in the tripolar world, competition between China, the U.S., and Europe. China has taken the high ground in the clean energy space. You know, Trump wants to end EVs, et cetera. The real fight now is AI, and I don't see that this is, you know, the two countries are separating their tech stacks. That's our whole thesis with China tech. And, you know, I think the issue right now is, do you want to press that bet, right? So you reduce the U.S. And you go further into Asia, which has been down 5 weeks in a row, is cheap and under-owned. I mean, those are the things you want to play.
As you say, he wants to end EVs. Tesla's absolutely soaring today.
Well, that's the Musk thing.
Who do you think is the biggest loser in terms of your tripolar world with this composition we see in Washington?
The U.S., clearly. Because Europe has got to respond. They know that. The whole Draghi report on competitiveness was we got to do more of the things that China and the U.S. are doing. And to us, there's a new industrial policy mix that is being implemented around the world. To compete in AI, to compete with climate mitigation, to compete in conflict, you need public-private partnership, because it's too much money for the private sector alone, and the public sector doesn't have the expertise. So who can marry that best is going to be the winner. And I think you also have to think about immigration. Who can leverage the immigration to improve their growth profile is also going to be a winner. And in the policy mix that the Trump team has laid out to date, it's anti pretty much all of that. And so, you know, strategically, as I said, the U.S. dollar is the most overowned, it's expensive, and the policy mix, in our view, is deteriorating.
There's a lot to unpack there. I just want to pick out a few things. The former president, now president-elect, has been quite clear that he wants national champions, which is why there's the proposal on the campaign to drop the corporate tax rate to 15% with conditions for domestic manufacturing. Now, you said, when asked who's the biggest loser, you said the US, and then you said clearly. It's the clearly piece of it that I'm going to push back on, because it's not so clear to a lot of people watching the program right now. Sure. You acknowledge that at the moment, I think you called it a hothouse theory right now in America. That's what it feels like. It feels like if you're investing in America, you'll do well. If you're trying to export to America, you might have a problem. That hothouse theory, what's the biggest hole in the window right now?
Well, I mean, I think it's J.P. Morgan who laid out the case that if Trump implements the 60% tariff on all China imports, that will lead to almost a halving of the earnings growth that's expected for 2025. In other words, the earnings are expected to grow by about $35 next year from this year, 25 to 24. The tariff effect will carve out $15. This is J.P. Morgan's estimates. They got, you know, reams of economists thinking about this stuff. And so you're basically talking about taking your earnings growth and having it at a time when, you know, you're not going to get multiple expansion. So it's all about the earnings growth. Year 3 in a bull market tends to be the year of rest. We are going into year 3. That's historically the case, typically single-digit returns. And so I think that the idea of national champions, sure, that's why Tesla's probably rocking. Musk is going to be one of the national champions. But I think overall, the whole thrust of the U.S. policy mix has been reshoring, right?
Got it.
And reshoring with the dollar getting more expensive, those two things don't compute. So that's a big hole in my view.